Hello everyone and welcome to Module 2. This is going to be a brief mini lecture on one of the topics that we'll be covering this week. Let me just reposition a little bit here. It's difficult to get everything in. All right, so the financial statements that we'll be covering this week are the income statement, the statement of retained earnings, and the balance sheet. The income statement reports the revenues and expenses and calculates the net income or loss for the period. The statement of retained earnings shows how retained earnings changed during the period. And the balance sheet reports your assets, your liabilities, and your stockholders' equity as of the last day of the period. The balance sheet is where you can actually see the accounting equation in action. This is a sample adjusted trial balance, and this is what we use to prepare the financial statements. So they're prepared from the adjusted trial balance. And as you can see, we have the account titles on the left. We have the balances here with the debits on the left and the credits on the right. And these would be the balances that are going to come from the ledger. So here we have cash of $12,200, accounts receivable of $1,800, office supplies at $100, and on down. And then we have, starting here, we have our accounts payable, which is our liabilities, utilities payable, salaries payable. Remember, anything that ends in the word payable is a liability. And unearned revenue is a liability. It means that we have collected the money, but we haven't actually delivered the product or the service yet. So we actually owe the customer something. We have to earn the revenue they've already given us. And so in that sense, it is a liability. And then we have common stock here. This starts our equity accounts. We have dividends. We have service revenue. And then all of our expenses are listed out. And then notice here at the bottom, the totals, they match, okay? And so if you've done everything correctly on your adjusted trial balance, you should have totals that match at the bottom. If they don't match, then you have to go back, work backwards, and figure out what you did incorrectly. And so you can see up here, the balance sheet accounts are at the top. And then we have our statement of retained earnings accounts right here. And then we have our income statement accounts. So the statement of retained earnings account is just that dividend account there. Here's another thing that I like to tell students to learn, to memorize, to repeat often, is that dividends come out of retained earnings. I'll say it again. Dividends come out of retained earnings. Say that over and over and over again. Dividends are not an expense. Dividends come out of retained earnings. A lot of students will try to classify dividends as an expense. They're not. They come out of retained earnings. They are not an expense of the business. They're simply something that we take out of retained earnings and we give back to our shareholders and our stockholders. Okay, let's go to the next slide. So the financial statements, they do have a relationship to each other. They're connected. And because they're connected, they have to be completed in a specific order. If you try to complete them out of order, you will end up missing information because you didn't prepare the other financial statement that you should have prepared first. So the net income or the net loss from the income statement is going to flow to the statement of retained earnings. So you have to do the income statement first, and then you're going to take that net income figure or net loss, whichever one it would be, and you're going to plug it in to a specific place on the statement of retained earnings. Then you can do the statement of retained earnings. And then you're going to take that ending retained earnings from that statement of retained earnings, and you're going to put that in the correct space on the balance sheet. Okay, so let's take a quick look at an income statement. This one is for 2 months ending December 31st, 2016. And we're going to start with our revenue here. And here they have service revenue of $17,500. And then we've simply listed out all of our expenses and we've added them together. Total expenses, $8,950. We subtract that from our service revenue figure and we get net income of $8,550. So now that we have this $8,550 figure, we can take that and we can plug it in here on the statement of retained earnings. So right here it says net income for the 2 months, or it might just say net income. And we just plug that in. Now here they have retained earnings November 1st, 2016, 0. If it is a brand new business, and this is the first year they're doing business, and we'll just assume this is the first 2 months that they're doing business, your beginning balance here is going to be 0. Okay? And then you're going to add to that the net income for the 2 months, and you would subtract any dividends that were paid. So $5,000 here, and this gives us a balance in retained earnings of $3,550. That balance there is going to flow through to the balance sheet right here. Okay, so this is what the balance sheet looks like. We have the assets on the left, and we have the liabilities and the stockholders' equity on the right. Just like the accounting equation, assets equals liabilities plus stockholders' equity. So this is what I mean when I say you can see the accounting equation in action here. We have the assets on the left. We have the liabilities and stockholders' equity on the right side of the equal sign. And note that they both equal. Your total assets, your total liabilities, and stockholders' equity are $113,550. And so we just plugged this retained earnings figure in here. The rest of these accounts we would get from the ledger. We would get the balances from the ledger. Okay, and so that is just a quick look at the financial statements. The 3 main types: income statement, statement of retained earnings, and balance sheet. There are more, but these are the 3 we're going to focus on right now. And remember, the income statement records your revenue and your expenses. Your statement of retained earnings records the change in retained earnings during that period. How did it change? Did it increase, decrease? So that's what that statement does. It shows you the change. And then the balance sheet shows you everything that has basically the business owns, basically everything that they owe, and the equity that they have in the business. All right, so this is your mini lecture for Module 2. I'm going to place this in the discussion, and I'll follow it up with a discussion question. I'll see you in the discussion.